Welcome to Taking the Higher Road, a special show dedicated to the trucking industry, specifically at the confluence of recruiting, retention, and compliance. In the fourth year as the host of this show, I bring over 2 decades of industry experience, both on the carrier side as well as the vendor side. And each week I interview industry experts and thought leaders who bring their insight to the driver lifecycle as we discuss the industry's greatest challenges. I always appreciate your feedback, good or bad. Don't forget to rate and review Taking the Higher Road on your preferred platform. I'd also like to thank and highlight the show's valuable sponsors. Their dedication and commitment to the industry and to the show is greatly appreciated. And if you're interested in being a sponsor of Taking the Higher Road or joining me for an interview, please email jeremy@takingthehigherroad.com. The guest and the topic of this week's episode couldn't come at a better time. As we struggle to navigate through these challenging headwinds, we're going to hear from someone who's an expert in what carriers should do as well as shouldn't do in order to give you the best chance of survival. I'm honored to be joined by a great industry friend and ally, Chris Henry, Chief Operating Officer at KSM Transport Advisors. Great to have you on the show, Chris.
Thanks, Jeremy. It's great to be here and been looking forward to this conversation for the last couple of months.
Yeah, same here. And as I said, the timing is right. You know, we've been dealing with this freight recession since mid-2022, and it feels like quicksand to many of us. I'd love to hear your background, how you got your start in the trucking industry, what led you to a career in helping others with best practices, and I'd love for you to share who KSM Transport Advisors is and what they're all about. I definitely want to dive into a few best practices that you can recommend for our listeners, especially with all your pattern recognition over the years. And perhaps you can share a handful of do's as well as don'ts. And I'd certainly love for your take on where we are in this current cycle and how important it is to stay engaged and connected to fellow industry peers as we're all going through the same challenges. And then lastly, we'll answer a question from a listener during our deeper dive segment. Does that work for you?
That works perfect.
All right. That's a lot.
Yeah.
But before we dive in, I'm curious if you have any book recommendations for the audience, anything you've read that's been impactful to you.
Yeah, I didn't get a lot of time to read last year. Typically, I like to do a book a month. But last year, I think I only did 3 books from cover to cover. The one I read over Christmas was Poor Charlie's Almanac. So that's a book written by Peter Kaufner. He's the editor of it. And it's kind of a culmination of Charlie Munger's life work in a book. So I'm a huge Warren Buffett fan, Berkshire Hathaway fan, value investing, all that stuff. And both Warren Buffett and Charlie Munger are kind of like the Benjamin Franklins of our time, and I guess their time. And so a lot of common sense stuff. But I highly recommend that book. Pick it up for audio or hardcover, but just a wonderful book. It's not just about investing; it's about how to approach life, relationships, time management, seeing people's perspectives. So one of the key takeaways from that book is always invert. So by invert, Charlie means looking at it from the other person's perspective. So if you're negotiating with someone, looking at it from your kid's perspective, looking at instead of what you want to achieve with a goal or a business activity, what do you want to avoid? So always invert is one of the key takeaways from that book. So definitely get Poor Charlie's Almanac.
Yeah, I appreciate that. You're not the first person that I've heard that from. And in fact, it may have been you who I heard it from before in an email exchange, but I have that on my list, and that sounds like a fantastic, it's certainly my speed and the stuff that I like to read. So thank you for that. And I think you're right. They are, the Benjamin Franklin of this era. So, and that's a good thing. So first of all, Chris, I've known you for years. You're a class act. I see you at most events. I've always enjoyed engaging with you. For those who may not know you, who is Chris Henry and how did you get your start in the trucking industry?
For sure. Well, actually, next month will be year 25 in the industry. So I actually got started. I'm Canadian, so I'm based in London, Ontario. Have never changed my location, although I do travel quite a bit. But I started in the transportation industry in 1999. And back in 2014, kind of pertinent to this conversation, my partner and I, Ray Haight, who was former Truckload Association chairperson, owned and was the president of a medium-sized trucking operation in Canada, about 300 trucks. We got together to look at helping carriers understand how they're performing relative to other carriers. So we formed a benchmarking software platform called StackUp. So StackUp's goal was to basically provide more transparency, but also educate carriers on how they should be tracking their performance from a financial point of view, variable costs, fixed costs, all that kind of stuff. So we grew that company for 6 years, and we sold it to FreightWaves in 2019. At the time of the sale, we had 239 trucking company profiles reporting their monthly financials to us. And in turn, those carriers were able then to compare and contrast their results anonymously versus this large population of carriers. So I think that made a dent with some carriers in terms of how they were looking at their financials versus how they were doing it before, and changed the way they contrasted themselves versus others.
So from that early on, and that, by the way, you mentioned Ray Haight. He's been a guest on the show, good friend, and glad to hear you bring his name up. So from those early days, you've been focused on helping carriers be better and see, how they compare with others and so on. And I think that's probably, kind of the natural transition, it sounds like, to KSMTA.
Yeah, so KSM, basically when I was doing benchmarking, we were able to go like a mile wide and about an inch deep. So we could tell you, what your revenue per truck per week was, what your operating ratio was. There's a number of different statistics, but they only went so far down in terms of the general ledger or the transactions, the orders, the dispatches, etc. The connection with KSM was a major supporter of StackUp. They referred a lot of clients to us, and we in turn referred clients to them. So we had a natural affinity for them. They were able to take our clients at the time, StackUp's clients, and help them understand, how do I need to take action to improve on these metrics that we're reporting to StackUp. So they were able to go a mile deep. So get right down to every dispatcher segment and customers, lanes, etc., and isolate essentially the customers and lanes that are stealing profit from your network, and the same are adding profit to your network, basically to better manage your companies and hopefully be more sustainable over the long term. So that was a connection there. They aided us in our growth on StackUp, and then it was a natural fit after we sold and I left FreightWaves. It was a natural fit for me to join the KSM folks.
So you're the Chief Operating Officer of KSM Transport Advisors. We keep saying KSM, Katz, Epper, and Miller, for those who don't know. I've worked with Katz, Epper, and Miller for over a decade from an accounting standpoint. Perhaps you can share a bit about, who KSM is, briefly, and then dive into exactly how KSM Transport Advisors, maybe how they came about and how they help fleet customers.
Yeah, absolutely. So KSM, Katz, Epper, and Miller, it's now called KSM Business Services. We're a 500 plus employee accounting, so audit, tax, as well as consulting on the healthcare side, location, local tax practice. They operate in 19 different industry verticals, transportation being one of the largest. So Tim Almack, who many of the viewers hopefully know that name, he was one of the leaders in growing that transportation practice. And one of the things that they identified back in the early 2000s was the need to diversify in terms of the service offerings within that transportation group. So they initially started doing some investment banking type work, but they had got connected with David Roush, who's our current president. And the focus at that time, or David's focus, was using analytics to better manage your company. And he had a long background in trucking. His grandfather started Roadway Express. He himself was the owner of a almost 3,000 truck operation, Roadcore International. And in that company, they used a network profitability model to basically understand how to improve and which customers to use to drive that performance. So basically what David did is he took that same model when he got connected with KSM and said, okay, how do we take it from just a one person consulting practice, your own operation, to a client-based practice where you take that model, overlay it on top of each carrier's network, and give them a tool set to better understand where the opportunities are in their network. So David started that practice in 2007, right before the Great Recession. Actually gained a lot of business because of that, and helped a lot of carriers, stave off going in the wrong direction. Some, prevented them from going bankrupt, which was awesome, and still to this day. But that practice grew over time, and we grew with KSM, and now we work with over 30 trucking companies throughout North America, primarily focused on irregular route, ad hoc, over-the-road truckload companies.
So David's a great guy. I've known David for a long time too. I didn't know some of that background, so that was encouraging as far as David is concerned. You mentioned the Great Recession. Early on, earlier in 2023, I remember having a conversation with somebody who hadn't been in the industry during that time. So somebody more recent, said to me, "Is this the worst you've ever seen it?" Talking about the environment that we're in right now. And I remember saying at that time, this was probably March of 2023, 23. What year are we? And I said, oh man, it was really bad in 2008-9. I remember I actually owned a small truckload fleet, small 20-ish truck fleet. And then I also had a driver staffing company at the time. And it was really, really tough. And so I dismissed it as, it's not so bad. Now, as last year progressed, I started having the same conversation with people, and I started getting a lot of mixed responses in what was worse and what they felt was worse, 2008-9 or the environment that we're in right now. Do you have any thoughts on that? What do you think?
Yeah, so we have some very strong, very smart operators within our client base that have been around for 3, 4, some going on 5 decades. And a number of them have said this is worse than the Great Recession, just because of the lack of clarity, how quickly things swung from good or awesome to terrible. So we kind of have a biased view, or a kind of, a narrower view, because the carriers that work with us as a byproduct of that, they want to get better. So we don't have a view into the entire industry. We can see everything's happening within FreightWaves and DAT and other sources in terms of price discovery. But in terms of the erosion in margin, erosion in the line haul rates, we haven't, as a firm, seen such a rapid decline than we did starting in the spring of 2022 to, basically today. We're at a stagnant period right now. And those strong operators have said this is way worse than the Great Recession. It hopefully is going to turn sooner rather than later.
Well, that's unfortunate to hear, I guess, but it is what it is. It's the reality that we're operating in, and I appreciate that perspective. I know, while the driver shortage, took a break as a top industry issue this year, it's certainly only because a much bigger problem has emerged, and that's the economy. It's certainly an underlying challenge that carriers are still faced with, and as I often share on this show, there's also a continually increasing risk of nuclear verdicts and settlements from a driver hiring and compliance standpoint. Since a majority of our audience revolves around the areas of recruiting, retention, safety and compliance, I'm curious if you might be able to share 1 or 2 best practices that you might impart on carriers that you work with.
Yeah, so 2 things. First, from a recruiting point of view, one of the things we try to do is build an activity-based costing model that we've developed over the years for every single client. So each one of those costing models is unique to their operations. And one of the areas that we see from with almost every carrier is discounting the cost of turnover, and what that can do to erode margin. So we did a analysis where we took all the direct and indirect costs of turnover, and we used about a sample size of about 50 trucking companies, flatbed, van, reefer, sizes from 80 to 1,200 trucks, actually 3,000 trucks. And the average cost of a lost driver was the range was between $11,000 and $25,000, and the average overall was $17,900, and that was years ago. So the adjustment for inflation and what cost bases are like today, I would suspect for the majority that's $20,000. So each and every time you lose a driver, that's $20,000 that's extracted from your bottom line. That's $20,000 you didn't make, you didn't deposit into your bank and retain in the form of retained earnings. So that's something, food for thought to think of. And if any viewer wants to reach out to go through that exercise, I can give them the workbook that we created to do that. So that's on the the recruiting / retention side. The other side of the equation is looking at top performing carriers from a safety perspective. And by safe, I'm referring to their FMCSA scores. That's kind of the only real benchmark we have of any substance and size. So there is a correlation, we believe, between those scores and overall safety performance. And then also looking at what the total cost of insurance was. So basically your cost of insurance, it's your risk financing. So your insurance carrier is taking a bet on you, and the lower your premium, the better bet they have that they're going to be able to make money on you long-term despite a lower premium. So we looked for that safe group. We looked at top performers from a safety or insurance premium, including deductibles, as well as accident, self-insured accidents, and those FMCSA scores. So the top 25% of the carriers within the group we were surveying, about 230 trucking companies, they were almost identical to the top 25% of carriers from an operating ratio perspective. So there is a direct correlation. So if you look at the top 25%, their insurance cost can be as low as 4 cents per mile with similar excess or umbrella insurance. And then the bottom performers can be 20 cents, 21, 22, even higher. So when you think about that, with the erosion of the line haul revenue, both contract and spot, and thinking of a carrier with a low insurance premium versus a high relative insurance premium, that advantage they have. So the thing that I reinforce there is it's not a cost when you're investing in safety. So technology, best practices, training, it's an investment, and it may take a little bit for the insurance carriers to get word of that in the form of good performance, but you'll be rewarded with that over time. And once you have that, it's hard to get rid of it.
Well, and to your point, it's an investment and it's not a cost. And I think too often it's viewed as a cost. It's a bottom line. It's an expense that can we cut this? And it's the understanding that this is an investment and this will pay dividends in a major way. What about from a are there any practices maybe that you uncover when you're working with a fleet, any of your customers, where you encourage them maybe to not do that anymore if there's something that they do? Is there anything that comes to mind?
Well, we don't get into, our practice typically is focused on the lanes, the rates, and the customers, and all the the levers built around those. But if they have good safety performance, one of the best practices we recommend is if you're confident in your operation, if you feel you are where you need to be from a best practices point of view, SOP point of view, a technology point of view, and safety, is to bet on yourself. So take more of that risk, whether more in terms of a self-insured deductible or examine captives. Because one of the advantages you have there is, and this is something that I'm relaying to a lot of carriers right now, is you have a lot of carriers that are exiting the market. They're exiting the market, but they're not, those liabilities that are connected to them, both incurred and reported, or incurred but not reported, they haven't exited the market. So those liabilities are sticking with some carriers, and those carriers are going to have to recoup those costs sometime from the remaining pool of carriers and insureds. So the better you can isolate yourself from that general population, the better. So bet on yourself. If you're confident in your ability to achieve better performance from a safety perspective, take on a little bit more of that risk.
Well, first of all, KSMTA and KSM both put out a lot of great content. And I recently came across the 12 traits of highly profitable trucking companies. And I think that's a great series of articles that are really inspiring to those who take the time to read and put them into practice. And especially, I think the timing is just perfect. Can you share a little bit about those 12 traits and maybe how embracing them can give fleets a competitive advantage?
Yeah, absolutely. So the reason we collectively put this series together was we were constantly being asked, okay, give me the tips and tricks that XYZ company or ABC company is using to get better. So what David and I did is at the beginning of 2022, we started talking about, labels that we attach to these role model companies. So we started with a group of about 100 carriers, and we attached descriptions of traits to each one of those. And we did essentially word cloud. So what are the traits that bubbled up to the top more often than not? And then over time, we whittled it down to which carriers exhibit the most of those top traits. So at the end of the exercise, we were left with 4 quote unquote role model companies. And these companies all exhibit the 12 traits that we wrote about in 2023. So each month we had a new trait. In 2024, we're going to be talking more about the how. So we talked about the why and, gave significance to each of those traits. But in 2024, we're going to talk about here are the things you can do to exhibit these traits or take on these traits yourselves. But basically, there's 12. I won't get into all 12 of them, but two of the key ones that I think your viewers should embrace based on these 4 role model companies is number 1, transparency. So to us, transparency isn't just about showing financial performance. It's being open in terms of dialogue, how to get better. And those 4 role model companies embrace both. So it's not just about old boys club at the top making decisions and telling people by demand to implement. It's about here's where we are relative to the market. Here are the opportunities that we see. What do you think? And then on an ongoing basis here's how we're performing. So financially, and one of the things as a byproduct of being connected with KSM is we see a lot of companies that are ESOPs, so employee-owned companies. And they have to be transparent by nature of how they're structured. And if we were to do a study over a 10-year period, I am very confident, we haven't done the study, but I'm very confident those companies would outperform their counterparts, especially within trucking, because they're being forced to be open about their performance. And as a byproduct, you're able to better identify high-performing talent. So those that are attracted to that data, are attracted to those discussions, are attracted to the openness, kind of bubble up to the top. So transparency is like the number 1 key trait that we think every carrier should exhibit, but it can be scary because, there's 2 arguments against transparency that we hear all the time. One is, I'll get asked for a raise. Well, once, your employees see how little of a dollar of revenue that is retained by a trucking company, I don't think you're going to have them asking for a raise. Number 2 is the opposite. They'll head for the door. Well, they're going to head, those people that would head for the door when they see challenging times or scary times, they're going to leave anyway. So it might be saving some time, energy, and effort by helping them find that door. But part of that too is educating the team on how the economics and how the market cycles work within trucking, the kind of financing you have arranged to weather those storms, whether it's cash or outside lending. So it's not just showing your financials and walking away. You have to provide context. You're going to see some really extreme highs and really extreme lows in the next 10 years. And here's how we're doing relative to that time period. The second trait I'll mention, which is connected to it, is the last one that we wrote about in December, and that's humble leadership. So each one of these 4 companies, and Jeremy, I know you know 2 of these companies very well, and we're going to be profiling them in 2024. Humble leadership is something that they embrace fully. So by that, I mean, it's not, I have all the answers. I'm the owner. I'm the president, the CFO. It's, here's where we are. Here's my opinion on the current situation. What does everyone else think? Let's talk about this. Let's be deliberate. Is this connected to our strategy, our long-term strategy? Is it not? How can we get better? It's asking the questions instead of, demanding the results. So that's 2 of the 12 that we think every carrier, and these are more foundational things. We get into more tactical things within that 12 trait series, but those are the 2 that I would recommend.
Yeah, I appreciate that. That's some really good stuff. And the 12 traits that can be found on your website. What is that? What's the URL? If you could share that.
So you can go to KSMCPA.com or KSMTA.com. And the resources or articles are linked on that page.
Perfect. I think there's a lot of good content there, and certainly want to encourage the audience to check that out. And Chris, it goes by so fast, and I really appreciate all your time. Thank you so much for joining us today. Appreciate the work that you're doing for the industry, and certainly grateful for our friendship and partnership. So thank you. And thanks for joining me for another episode of Taking the Hire Road. Stay tuned next week as Sadie Church, president of Recruit, Hire, Retain, joins me on the show to talk about her new venture. And once again, special thanks to the sponsors of the show. We really appreciate you. If you're interested in being a sponsor of Taking the Hire Road or joining me for an interview, please send me an email at jeremy@takingthehighroad.com. And lastly, don't forget to rate and review Taking the Hire Road, and please share or forward to your industry peers. Until next time, thank you for taking the Hire Road.